We've been working on this episode for a while now. It's become an incredibly important topic, stock-based compensation, or SBC. So stock-based compensation really reached a fever pitch in 2020 and 2021 during the market bubble. A lot of companies are now being exposed for really completely misusing stock-based compensation. It's burning a lot of shareholders now, specifically in software technology stocks. So in this video, we'll cover what stock-based compensation is and how you can measure it and its effect on you as a shareholder of a business. Before we jump in, just a reminder, please consider subscribing to our channel below if you find this video helpful as you do your investing research. We really appreciate the support. Okay, so let's dive in. Why put this discussion of stock-based compensation on the Chip Stock Investor channel in the first place? The channel about semiconductors and computing technology investing. Well, I think the answer to that question will become apparent here in just a moment. But first, a definition. What is stock-based compensation, or simply SBC? Many tech companies have been using it for decades as a way to attract and retain their top talent. SBC is also often used as a way to reward management or the executive team of a company. In fact, this is often used throughout the corporate world, not just in the tech space, but in particular, SBC to average employees outside of management or the executive team really is almost a defining trait of high growth tech stocks these days. Oftentimes it's also used as part of an acquisition when one company is acquiring another as a way to kind of retain management or some key employees of a business that is being acquired and integrated. So stock-based compensation is a really big deal for you and I as passive shareholders, non-employee shareholders of a business, as SBC can dilute our ownership of a company. So here's an illustration. Let's call it Company X. They have 100 total shares outstanding. They generate $100 of profit, and you own 10 of those 100 shares, or 10% of the company. You're a 10% owner. If $100 in profit is generated, that means $10 of that profit is attributable to you, or 10% of the $100, $10 in profit. Now, let's say Company X goes and doles out 10 new shares, or a 10% increase in stock-based compensation, and it does that to maybe reward its management team. Now, your 10 shares only represent 9% of the company overall. So if the profit remains equal at $100, now instead of getting $10 of that profit, only $9 is attributable to you, or your 10 shares divided by the new total, 110, which equals to 9% of the total company, or $9, roughly $9 in profit. That's dilution. More mouths to feed means you get a smaller slice of the pie. So that begs the question, why in the world would a company ever use SBC? I mean, it would completely run off all investors, right? Well, not exactly. A lot of this has to do with the tech world and how it operates. There are very few true competitive advantages in most tech businesses, except for their top employees, their top talent. It might be a superstar engineer that's heading up the development of a new project, or maybe it might be retaining key employees after a competitor has been acquired. If those key employees or that rock star engineer were to leave, they could bring their incredibly valuable talents to a different company, or they might leave and start their own business and become your next competitor. Neither of those scenarios would be very good. So that's where SBC comes in. It helps give buy-in to the employee and keeps them put. Plus, if an SBC package can help fuel growth of revenue and profit by maybe boosting employee buy-in and morale of the business, keeps them working hard, keeps them productive, all the better. So while there might be more mouths to feed by doling out new stock to employees, shareholders might be happy if management is able to explain that, hey, because we retained all of this top talent, there's more profit to go around now. So yes, there are more mouths to feed, but the pizza pie is getting even bigger than that. So your slice, while maybe a smaller percentage of the total, might be a lot bigger than the piece you would have gotten otherwise. So let's use our same example, Company X, again, as an example. And let's say Company X increases their share count by 10%. So now there's 110 shares instead of 100 because they've paid out some extra stock to employees. But instead of profit staying fixed at $100, let's say it goes up 50% to $150. Now, instead of your 10 shares each granting you $9 in profit, you get $13.50, or because you own 9% of the shares outstanding, multiplied by the $150 profit, $13.50. It isn't as good as if the share count maybe remained static at 100 and then profit increased 50% to $150. But perhaps management explains the SBC away because they hired a key employee and that project that they headed up was responsible for that extra $50 in profit increase. Okay, fine. We're good with that, right? This is basically the dynamic, the rationale that has been going on in the tech world for a long time. Technology is all about constant innovation, constant disruption. And so it's very difficult to create a business that has a true competitive moat. And so if you're constantly trying to innovate, create something new, and generate growth that way, well, SBC becomes a very important part of your corporate culture to attract talent and thus increase the growth of the business overall. So Casey actually put together this great timeline on how we got here in the first place. So a form of stock-based compensation actually got its start all the way back in 1950 after there were some tax reforms following World War II. And so a form of SBC called stock options quickly became part of an executive pay package in corporate America. But the use of stock option awards given out to actual employees was really pioneered by, you guessed it, this brand new industry that popped up in Central California, making these things called semiconductors, or eventually simply just chips. So not holding on to a star engineer was a nail in the coffin to many of the original startups in Silicon Valley back in the 50s and 60s. Stock option awards thus to hold on to these key employees, these key engineers, some of which went on to win Nobel Prizes for their work. SBC became part of the DNA of Silicon Valley to hold on to these talented individuals and to make sure they didn't leave to a competitor or start up a new chip company. Check out the timeline. Casey put a short video together. The link to it is below in the description. Check it out. Okay, let's fast forward now to today. So SBC has been put under a microscope for a lot of tech companies, software technology companies in particular. While their valuations were sky high in 2020 and 2021, early on in the pandemic, when it seemed like a digital business was literally the only viable business during lockdowns, many of these companies were able to gloss over a very, very high rate of stock-based compensation paid to their executives and their employees. But now that stock prices have crashed, we've got problems. Some of these companies are still doling out a very, very high rate maybe 10% or more of stock-based compensation as a percentage of their total shares outstanding every single year. So if revenue and profitability rates start to fall close to, or even worse, below that new SBC issuance rate, well, we've got really, really serious problems. Like we did with our example company X that increased its share count without increasing profitability. But that's not to say SBC is all bad. How can we measure it in such a way that we can figure out if it's okay or if it's becoming a serious problem for you and I as shareholders of a business? Well, let's start with good old-fashioned, unadjusted GAAP, or generally accepted accounting principle, earnings per share, or GAAP EPS. So GAAP EPS, that measurement really hits companies using stock-based comp really hard. It hits them two ways. So not only does GAAP earnings per share include stock-based compensation as an actual expense, it lowers the profitability. You also get the new issuance of shares as the divisor in the equation. So when you take net income and divide it by a higher share count, all of a sudden SBC can become a very glaring problem for a company. Maybe their earnings, their net income has stalled out, or maybe they're not making progress in getting to profitability in the first place. Plus they have a rising share count. We can very quickly see where this becomes a problem. This is a perfectly acceptable method for you to use, especially if you're a value-oriented investor and focusing on earnings per share. GAAP earnings per share is your preferred metric. But there can be some nuance to this discussion. And you know, I love talking about different nuances, different angles to an argument, because many companies out there, again, tech companies in particular, might try to hide their stock-based compensation behind adjusted or non-GAAP earnings per share measures. So this metric that they use oftentimes subtracts stock-based compensation out of the net income and then divides it by the higher share count. So the company is still getting penalized maybe for the higher share count, but if you're removing stock-based compensation, which is a non-cash item, remember the company's paying stock, not cash, to the employee, it can really hide the fact that SBC is becoming a problem. There's also some controversy out there regarding the use of free cash flow, or FCF. This is another non-GAAP metric that excludes non-cash expenses like SBC. But this is by design, since free cash flow is literally designed to measure a company's ability to just generate cash, actual cash profits. SBC is non-cash since the company is paying the employee in stock, not cash. But some analysts out there think that maybe SBC should be subtracted from free cash flow anyways. I disagree for all of the reasons I mentioned earlier. Free cash flow only measures a company's ability to generate cash. There is a simple solution though, one that I do not see getting used all that often. If you're worried about the free cash flow, let's measure free cash flow per share. Free cash flow on a per share basis, just like we might use earnings per share. So when we divide free cash flow by shares outstanding, and those shares outstanding are increasing because of SBC, you can see its effect on free cash flow growth. If free cash flow per share is continuing to rise, you might maybe still be happy as a shareholder, or if it's starting to stall out because of a high rate of stock-based compensation, maybe not. Maybe it's time to move on. But I like to keep it simple. Just simply use free cash flow on a per share basis if you're worried about stock-based comp, or if you really want to avoid companies altogether that have this problem, don't overthink it. just use GAAP earnings per share. There are some other additional metrics floating around out there that can be misleading. One of them is stock-based compensation as a percentage of total revenue. This might be a really interesting sounding, even maybe a shocking metric to look at, especially if maybe a company is paying 15%, 20%, or maybe even more in stock-based compensation out to employees as a percentage of revenue. But all on its own, this metric just isn't really all that helpful. It doesn't help you assess the stock-based compensation's effect on you as a shareholder. What matters the most is either the number of shares a company is doling out in new stock-based compensation as a percentage of the existing shares outstanding, or the value of the stock-based compensation. How much money worth of stock-based compensation is being paid out to employees as a percentage of a company's market capitalization, which is simply the number of shares outstanding multiplied by the current price per share. These two metrics are far more important than stock-based comp as a percentage of revenue, because the divisor in your calculation for either earnings per share or free cash flow per share is the number of shares outstanding. It has nothing to do with the revenue itself. Or alternatively, if you're trying to put a valuation on a stock, on a business that you're interested in buying, you might use market cap, an evaluation metric like market cap to net income or market cap to free cash flow or something similar to that, in sticking an actual value on the stock, kind of like price to earnings ratio. So that's a lot to chew off. In coming videos, when looking at a company that might be having an issue with stock-based compensation, I'll walk us through these steps that I look at in assessing its effect on a shareholder or as possible shareholders of the business if I'm trying to decide whether a stock is a good buy for myself or not. I'll go through those steps so you get some examples. Feel free to leave some comments below on this topic. Feel free to ask if you need help in making this calculation in a stock that you own or one that you're considering buying. Let's open up a discussion on this, because I think this is a really important topic, this SBC, and how it might be destroying our value as part owners of a business. Thanks again for tuning in, everyone. We really appreciate your support. If you found this video helpful, hit the like button, hit the bell so you're alerted when new videos drop, hit the subscribe button. We'll see you next time here on Chip Stock Investor.